And welcome out to our show here on 9/23/2021. It is the day after the Fed decision. We've got markets firing off. We're going to break it all down here on our halftime report here, the daily show we have at Tackle Trading, where we go through these markets one step at a time, analyzing the news, breaking down the chart action, going through individual company stories, you name it, help you guys better run your daily routine as a trader with the community here at Tackle Trading. And as a community, there's one thing I always ask you guys as we're getting the show started each and every day. Hashtag Team Tackle right in the chat. Let's get that convo started in the way you guys always do. Positive, lively, helping each other, asking questions. Loved it recently. Keep that energy up there, guys. And by the way, if you're brand new to this channel, never been here before for our show, welcome out. We do this show every day. Markets go live. We go live at 12:30 Eastern. Make sure you click subscribe. Click that bell and come back and join us. And if you truly want to learn how to be a trader, join our community of pro members with a 15-day trial. There's a link in the description of every one of our YouTube videos. Let's get right down to business here and right into the market analysis. Bring the coaches in. First off, we've got Coach Greg Old Money Holmes here for his Thursday appearance. Going to be doing a focus on fundamentals segment a little bit later in the show, teaching you guys a little bit about PE ratios. We'll set that up when we get there. Matt and Mark, obviously, to help me break down the markets as always. Matt, how are you doing today, sir?
Oh, technically, I'm doing fantastic. Fundamentally, I'm dying a little bit today.
There's context there, and we will give that
I think Team Tackle understands.
The veterans know exactly what you're talking about. That's exactly right.
I died. My conservative monetary philosophy of life died a little bit yesterday, but I digest. We'll get into it.
If I bought you a Paul Volcker T-shirt, would you wear it?
Every day of my life.
I might.
How do you know? How do you know I don't have Paul Volcker pajamas on all the time? I've seen you wear it. Like my underwear is Paul Volcker right there. Let's go.
I like it.
He's a hero.
Yeah, Mark, how are you doing today, sir?
Dude, I am technically doing good.
Technically, we're all doing pretty decent here.
I made the little thing about SoFine yesterday. I was trying to think something with the SPY today. I couldn't come up with anything clever. I spy. I don't know, something.
I spy with my little eye retracement.
Buying the S&P 500. That's what Mark wanted to say.
Oh.
And by the way, Greg, congratulations from the chat here on your win last night on Trade Masters. Welcome
Greg.
to our show. How'd it go last night? Obviously, you won.
Yeah, it was a little touch and go at first. There was a pretty big vote against me for the Delta pick there. Tyler came out of the gates hard, but kind of petered out after a while. It's kind of just like the horse racing, you know what I mean? Out to an early lead and then just fell off as I.
Greg's saying I'm the stallion that has the longevity.
I was hanging out with Coach Tyler last night about 11 o'clock last night, and we were chatting about it, Greg. And Tyler says, "I want to recount, Matt."
I'm like, he's salty.
That's not the way we work.
He is salty about it, Greg.
Hey, you know what? It was completely the community that made the choice. It wasn't. There was no subjectivity. His picks were very Tyler-esque. My picks were very Holmesy-esque. Like it was perfect. It was. I enjoyed that so much. It was so great.
I like it. I like it.
The nice thing about it, Greg, now that I don't have to judge you, as I can come in on and beat you.
Did I hear a challenge?
Did I hear
a challenge next Wednesday? You can't talk trash like that and not back it up.
I'm laying it down, Greg.
The belt.
All I know is, Greg, I will put myself to the humble voters next Wednesday when I face you to try to dethrone the king.
Just a heads up for you, Mark. Tyler tried the underbelly, and it didn't work out so
Hold on.
last night.
I do have one very important question, Tim, and this is for Tim. Tim, who do you think is going to sell the lower delta naked put next Wednesday?
Ooh, let me guess. Greg or
is
Mark?
Greg going to go like a 3 and be like, I'm going to show him a 10% with a 3? Like, it's going to be, how conservative can you get next week? That's going to be next Wednesday's show.
How consistent of a cash flow strategy can you present and make it sexy and spicy? I'm gonna tune in. I think that'll be a fun.
I'm gonna show you how to cash flow without a thought, never care, and get 1% monthly without even worrying.
The mistake Tyler made last night, Greg, is he didn't give you the respect you deserve. I will not make that mistake next Wednesday.
He thought he was doing a walkover, did he? So
Mark's already positioning himself for the audience. I like it, Mark. You got to go full wrestling here. Absolutely.
It kind of feels like the week after I might be destroying somebody, but we'll figure that one out.
I want a piece of this at some point.
Hey, you know what? It's the justice trifecta. I'll take it all on.
Listen,
bring it my way.
I think somebody needs a humbling lesson.
I'm loving it now. Now I got to go back and watch a replay, Greg. I've heard both from you and from Tyler. Tyler is definitely still salty. He does not think he lost that matchup. But hey, listen, the votes are what the votes are. So that
votes count. Votes matter.
Right.
Congrats to Coach Greg.
Congratulations.
Thank you.
Let's get down to business here. Obviously, the market firing off. We'll get to the technical response here in just a minute, Matt. This is after the reaction yesterday to the Federal Reserve leaving interest rates unchanged, not clarifying what they're going to be doing on tapering. A lot of interpretation going on here today. You're the guy I go to for this. What is your read on what the Fed said, did, and what we are seeing from the market?
Well, we were the three of us, Tim, yourself, you and Mark, were sitting here watching the Fed yesterday after we got done with the halftime report. And, the initial reaction was, wow, Fed went a little hawkish, right? Because of the dot plot. And what happened, there's three aspects to this Fed policy yesterday that we really kind of just need to quickly talk about. Number one is monetary policy. They did nothing with monetary policy. That's number one. Monetary policy is interest rates, and there is no change to the interest rate, and there is no anticipated change to the interest rate, and there is no future anticipation to an interest rate as of this point. And I'll explain why I say that here in just 1 second. The dot plot came in suggesting that there's a 50-50 likelihood of an interest rate hike in 2022 versus a 50-50 likelihood of an interest rate hike in 2023. I'm not sure what a punt is at the Fed, but I'm pretty sure that's what a punt looks like at the central bank when you literally have 50-50 projections and everybody and their dog is widely speculating on what that means. Now, I'm not sure that was the intention of the central bank, but I kind of think it was the intention of the central bank. The central bank has not been transparent in the last 3 months, but they really haven't been transparent in the last year. Yesterday was a literal punt from a monetary policy perspective. The second thing we need to discuss is tapering. Tapering is not necessarily monetary policy. It's stimulus. And so right now we're injecting $120 billion a month in QE into the New York banks. That $120 billion was expected to start tapering at some point this year. The debate was, were they going to announce that you have two timelines we're working under from tapering? And why this timeline in tapering is so important is because we can't even discuss liftoff from an interest rate perspective until we have a solidified timeline from a tapering perspective. And that's why I say the dot plot is nonsensical. It brings absolutely nothing of value to the table. It is not an indication of absolutely anything. It is nothing, 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 and nothing more. And the reason that's the case is, number one, it is never accurate, literally ever. The amount of variables. Guys, I truly do believe 100% 3 weeks ago, the Fed was ready to taper. Fundamentally, they were ready to taper. The announcement was going to be made. The only thing that has changed in that 3 weeks is the market has went down. That is the only thing, okay? There are variables that exist between now and a year from now where the dot plot just simply cannot be accurate. And I said this the other day. Some of this is, yes, I absolutely believe the Fed has some blame at their shoulders and at their feet regarding the inaccuracy of the dot plot historically. I absolutely 100%. But I also understand why it's inaccurate, because it is very, very difficult to project out the inflationary environment, the labor environment, the economic environment, the global supply side concern environment, the COVID environment, the political environment. It's damn near impossible to project that out a month from now, let alone a year from now. And so when I say the dot plot is completely inaccurate and means absolutely nothing, I don't want that necessarily to be heard as a critique of the central bank. it's really not meant that way. I have other things to criticize the central bank on for falling asleep at the wheel regarding an inflationary environment, but that's a different conversation. Regarding the dot plot, it is really just difficult to project that far out. But the dot plot does suggest 9 and 9. 9 interest rate hike. 9 individuals expect an interest rate hike in 2022. 9 expect one in 2023. Once again, the reason that's difficult to assess from a timeline perspective and thus update your economic projections is because Jay Powell has been very clear with us on one thing and one thing alone. And this is the only thing he has been clear on. Tapering is not an indication of liftoff. And the test that they go through with tapering is a different test than the test they go through with liftoff, which is when they start adjusting the interest rate, and really the cause for concern because interest rate adjustments do have an economic impact. There's absolutely no doubt about that. And so you can't really assess the timeline for liftoff until we know exactly what the timeline is for tapering. And so the timeline we were all, and when I mean we, I mean market participants were up until this week, the timeline we were all kind of working under, and this is based on what the Fed has told us out of Jackson Hole, what they told us in their June meeting as well, is that they were looking at tapering beginning this year. It was either going to be announced in September, started in October or November, or announced in November and started in December. And they were looking at getting that done about somewhere in the second quarter of 2022. If you go off that timeline, then you can easily see liftoff at the back half of 2022. But what has occurred today over the last 24 hours is we are shifting the goalpost. We are buying more time to see if some of these economic concerns can quite frankly fix themselves, because the Fed is 100% asleep at the wheel at this point. And so when you're looking at the timeline from a tapering perspective, the updated timeline is we are looking at tapering, and it does look like tapering will occur this year, but now it looks like the announcement sometime in October, maybe the November meeting. The soonest they could begin tapering is right around December timeframe. That puts at a $20 billion tapering plan, that puts tapering over at really kind of the end of the second quarter of 2022. Well, if you push back all your timelines 3 months from a tapering perspective, I find it extremely difficult to come to the conclusion that interest rates will actually lift off in 2022. Remember, in June, there were 7 of 18 voting members that expected 2022 to be liftoff. Today, there are 9 individuals that expect 2022 to be liftoff. But in that time frame, we have shifted out 3 additional months from a tapering perspective, which means they have an extremely tight window to fit in tapering, to fit in liftoff in an environment where even the Fed's economic projections for next year have now been contracted from 7% growth to 5.9% growth. And we've seen the Fed come off tapering simply with a tiny dose of market volatility. Paint me extremely skeptical that the dot plot suggestion that 2 additional members see an interest rate hike in 2022 will occur. I actually believe the opposite of what the market believes here today. I believe I believe that the Fed is actually pushing out the decision on interest rate, not bringing it into 2022. I find it very, very difficult to believe at this point where we're going to see liftoff in 2022. It is just, remember, you got to go with what Jay Powell has stated. We're pushing out the time frame 3 months from a tapering perspective. Powell has stated that tapering is not an indication of liftoff, that those are completely different equations in and of themselves. This looks to me like a dovish punt. This looks to me like an absolute dovish punt by the central bank, and thus why the market is buying it.
Well, they didn't do anything with interest rates this time. They delayed the first action that they were intending to take, which was tapering. And so, yeah, it feels like a dovish punt to me.
Well, it honestly, just one last thing, and then I'd really like to hear Mark and Greg's thoughts as well. one last thing, in terms of their economic projections, two very important economic projections that I do think need to be fixed up. And what I really believe is happening here, guys, this is just my wide speculation, but I'm going to give it anyways. What I think is happening here is the Fed's looking at two different environments. They're looking at their economic projections in 2022, and they're saying, we felt like we were on this great economic path of recovery. We've hit some bumps in that road. We were expecting 7% growth next year. Now we're only expecting 5.9% growth next year. Okay, that's number one. Mm-hmm. Are we really going to start lifting off interest rates when our economic projections are not even going to come to fruition? And they know that. And also, their inflationary projections, which is one of my biggest concerns economically, is they are now expecting 3.7% CPI report next year. The Fed was projecting a 3%. Their own expectations of inflation for next year are now increasing, despite the fact that they are still claiming this is a simple supply side problem from an inflationary perspective. What I, again, feel that is happening here, guys, is the Fed's punting because they're trying to buy a little bit more time to see if the inflationary situation truly is a supply side or if there's other factors playing a role here.
Yeah, decreased GDP projections, increased inflation expectations. I saw some of that data as well as a little bit of a head scratcher against what they were also saying with some of the other things in terms of market analysis. I do want to hear from Mark and Greg on this topic. Mark, what is your reaction to the Fed yesterday? Market reaction here. What are your thoughts?
Well, I mean, it's the market reaction, you headed into the week with a wall of worry. And if you want to see that wall of worry manifests itself in a bipolar aspect, you should have seen Jim Cramer this week. It was sell everything and then buy
let me
everything.
guess, he's now buying everything because all the wall of worry is gone.
And a lot of that is the simplistic. You headed into the week with a wall of worry. You had the debt ceiling, you had Evergrande, you had a Fed meeting. Two of those three things are now passing us by in one form or another, at least in the short term, right? Mm-hmm. And that wall of worry, as those bricks come out, and we talked about this analogy at the start of the week. Yeah. When you pull the bricks out of the wall of worry, the whole structure of the wall of worry starts to crumble, and you get some lift off here. So, as far as the Fed big picture, I'll just defer to Matt on that. Market reaction has been very, very positive, though.
Greg, thoughts on the Fed? What's going on with the market and reacting to the Fed and all these topics?
Yeah, so it feels to me, and obviously Matt did a much better job, delving into this than I ever could. But they threw us a nothing burger, and it reminds me of another nothing burger they gave us a long time ago that said, "Well, we're going to consider talking about having a meeting about considering about talking about an interest rate."
I remember that one.
It almost like it's echoing in a chamber hall for me that, you know what, these guys are just clueless. They have no idea what the heck's going on. So why not punt it? And that's exactly, I think, Matt, that's probably the best analogy I've ever heard of it, is they've punted it along. They'll kick the can down the road. They've been doing that for years anyway, and see what happens. That's kind of really how I feel about it. Now, I like the market response. I like, maybe the whole market's looking at it going, hey, if they're not going to worry about it, neither are we, and back to business as usual, back to towards all-time highs again. I'm happy to see it as a trader. So.
Well, and I think there is some of that psychological going on right now with the traders saying, yeah, we're over the last 3 weeks coming out to a little bit of a bigger picture here. We'll look at the weekly chart. Over the last 3 weeks, you've seen a recent bout in volatility. Markets went down about 5%. And, up until yesterday, before we had the Fed, you were testing a very, very important technical zone, that 20-day moving average on the weekly chart. Well, I do think there's a little bit of that today with, people, Mark, you referenced Jim Cramer, but, that's basically what I've been seeing across the board out there with a lot of Wall Street type individuals is saying, yeah, we got that wall of worry, right? We got the Evergrande situation. We got the central bank with tapering and reduction of monetary supply. We have the overriding political environment that is just, let's just throw a word out there, terrible. Right. And so you have this wall of worry. And then as you start to reduce some of those uncertainties, the market does get a little bit more confident. And now you're coming into one of those biggest worries, because honestly, the Evergrande situation, that is a microcosm of a concern regarding what the Fed can represent, right? We're talking the central bank, which is the number one market participant, owns $8.3 trillion worth of assets here. And so when you're talking about that wall of worry dissipating a little bit, it's to a certain extent simply a mirage. You're talking about a $300 billion problem with Evergrande. And do we really think the $18.6 billion that China put in, not to Evergrande, but just to, in terms of liquidity into their financial system, is going to fix that problem? Or does it simply delay that problem? When you're looking at the central bank here today, I wouldn't say the central bank fixed anything today. I wouldn't say the central bank did anything today. I think if you want to see what a punt on 2nd and 6 looks like in the NFL, the central bank just gave you the case study yesterday. They punted on 2nd and 6. I mean, it was absolutely ridiculous. But that does dissipate the concern in the short time, because think about it. All we're doing here is delaying the Evergrande situation. That situation's not fixed. That debt situation, we haven't even started to see the beginnings of the hallmarks of a debt explosion and what it looks like. When you look at the central bank, they didn't fix anything. They literally stated, we just want to get a little bit more time, because they're trying to see if the supply side concern with inflation truly does fix itself. And the central bank wants to take absolutely zero responsibility in creating the inflationary environment in the first place. So what is the market here? The market hears that this concern with Evergrande is dissipated in the short term. Good. Buy. They wanted to hear that the central bank's concern of tapering was dissipated in the short term. Good. Buy. Here's the thing. We know now, today, at least this was what the market's kind of psychologically feeling here today. China's got our back again, right? Didn't you guys hear that a little bit today?
Yeah, the PBOC injecting liquidity.
Yeah.
Okay. So over the course, I'm getting to my point here. Over the course of the last, 3 months, we've been feeling a little bit of up and down nature of the market, right? And the market's kind of lacked that theme, right? It's lacked that generalized theme to really start getting it to cook. Well, I haven't heard Mark talk about one crew in a while here. Well, one crew's coming strong in the last 24 hours, guys. With the Bank of England, we're sitting on our hands. With the FOMC, we're sitting on our hands. With the People's Bank of China, we're not only going to sit on our hands and do nothing, we're going to pump in $8.9 billion of fresh new liquidity into the system. We're going to delay at least 3 months more timeline on any tapering situation. Here's the market participants coming back in saying, the banks have our back again.
No, and if you don't know what Matt's referring to on one crew is the series 100 reference to you're either part of one crew or not, and we use it to describe the institutions, government, central banks around the world. Like, we are supportive of markets, we're supportive of markets, and China adding liquidity, saying, listen, Evergrande might fail, but our system isn't going to fail. We are here. We're going to add liquidity. We're aware of the situation with what the Fed. You are seeing a one crew over the last 24 hours. I think it is notable.
Well, and again, I'm just painting the picture of the market now, saying, they got our back again, because there was a little hesitation there for a moment. So I do think there's an understandable price response, because if the Fed's going to say, we're not going to taper and we're going to delay 3 months out, and China's going to come in with fresh new liquidity, and everybody's trying to at least put a Band-Aid over the dam that is breaking economically, at least they're making the effort, and they still have your backs. I'm not sure I agree with the overall sentiment, but I can certainly see that sentiment playing out over the last 24 hours.
Yeah. Guys, I love the thoughts on all these different topics. The Evergrande thing, obviously, it's been back and forth here for about a week now. It seems like a pretty quick speculation as to whether it is completely settled. I do like the PBOC injecting liquidity. Don't get me wrong. I don't think Evergrande's story is completely written yet. 100% though.
Well, nothing's been fixed. There's been no attempt to fix anything.
Yeah.
Okay, so let's be clear on that. Again, this is simply about pushing out the problem.
Yeah.
It's the proverbial, hey, let's not pick up the can and throw it in the trash can. Let's just kick that can a little further down the road so that we don't have to deal with it right now. That's what I kind of feel what's going on.
Absolutely. Absolutely. All right. Let's get the technical response next then, Matt.
The technical response is fascinating to me because what you're seeing over the course in the market open, guys, tells you a little bit about that general collective thought of all the market participants, right? And we kind of take a look at it from a technical perspective because just to get an indication, where's the entire market moving? And when you look at last week and you're looking at some of these cash opens last week, cash open, down, 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 right here, cash open, down, 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 down. Coming into Monday, cash open, down, 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 down. Even here coming into Tuesday, right here, cash open, down, down, down. Well, coming into the Fed on Tuesday here, all of a sudden, Wednesday here, Thursday here. So over the course of the last week, every cash open down, a continuation down. After the central bank, or excuse me, not after, but the day of the central bank, okay, the day of the central bank, here's the cash open. Right there. Right there. Boom. Gobbled up. Here's Thursday's cash open. Right here. Boom. Gobbled up. You're seeing a shift in market mentality in the short term, and the cash opens are giving you a little bit of an indication. But even with the cash opens being positive, remember, over the course of a trading day, we have certain time frames that we like to track. You have the cash open, which kind of gives you that overall market mentality going into the day. Typically, we do see a little bit of carry through from that cash open. You see it. You see the cash open here. You see the carry through. Cash open here, you see the carry through. And then as you get through the midday cycle, it starts to get a little bit boring because, again, there's not a lot of information that the market's getting into the market during the actual trading day. And so it does get a little bit methodical, and we typically see a little bit of slowing momentum. We're seeing that here today. But you also have a very important last moment of the trading day right there at the end of the trading day for about 30 minutes called the market close. And a lot of times you'll get a little bit of a fake out with that cash open. So the cash open will happen, give people a lot of confidence, but then the real traders come in at the end and be like, no, we were kidding. We were just day trading, guys. That's all we were doing. We don't want to hold through the overnight. We're not going to carry that risk through the overnight. We were just playing around. We were just joking with you guys. We're going to buy up the price, but then we're going to dump at the end. We see it quite a bit. It really kind of gives you an indication of the market mentality. Well, all of a sudden you see the market get bought up. That's obviously all central bank. After the central bank, little bit of a temper tantrum there. After the central bank comes out, look at the fade back up coming into the close. Market pops up, consolidate. Let's see if we can get another nice little methodical response coming into the close. So I do think over the last 48 hours or so, but really kind of from yesterday's cash open till currently right now, I do think the market mentality is shifting a little bit. You're seeing market opens get bought up, and you're seeing stabilization at the end of the trading day. Can that continue is a very, very important question for me, because as I've stated for the last week and a half, as we've been breaking down this short-term bearish downtrend in the market, is what you have to start seeing for this market reversal to really have some legs is you got to start seeing that intraday analysis start to turn over. And we are seeing that intraday analysis start to turn over, but yet the problem you have is you got to see that a little bit more consistent on the intraday. And the reason is we just barely got back up above that 4,400 zone on the S&P. You just barely reclaimed the 50-day moving average. At this point, the analysis in recovery analysis is about maintenance mode. We got to see 50-day moving average and 4,400 really kind of solidify itself and hold itself, because if you can play a little bit of offense up here, you're going to see a market response where you're going to start seeing a lot of traders want to chase price. That could be a very good trending environment. But again, we're not completely out of the woods here. I do like the market response. I like the cash opens over the last 24 hours. I like it getting back up above the 50-day moving average. And quite frankly, guys, the only thing I heard the central bank say yesterday was you better buy.
Yeah, you even talked to me
and by the way, not you better buy because, oh my, this is a great opportunity. No. I heard Keith King's voice in my head. Plug your nose and buy.
Hold your nose and buy. And by the way, that was developing even as we were watching, and it felt like it wanted to break out. Then it did it through the intraday. The intraday analysis is firming up here. That 4,400 was a key level. 4,420 to 30 was also key for me.
Very clear.
All support. Yeah.
Remember the context around what Keith King was talking about when he said plug your nose and buy. He was talking about trading the technicals despite the lack of belief in fundamentals. That's what that statement means. The focus on short-term technicals having a greater impact than the backdrop of the uncertainty of the fundamental condition.
By the way, I do want to get a read on one other index real quick here, Matt, the Russell 2000 next, if we can, because I was going through all those charts as you were talking about the S&P 500. It feels like it is in that development process a little bit sooner than some of the others in terms of the intraday analysis. I know the daily still got that longer range going on here. What are you seeing in the Russell? Because it's got some relative strength, in my opinion.
Yeah, over the last 2 days, it certainly does. I think energy and the banks have a lot to do with that, though. So I would say you're really talking energy and finance with that type of outperformance. But the underbelly has been, I just love that categorization, the underbelly. But the underbelly has been firming up as well over the last 24 hours. I would have a different take if the 200-day moving average would have held, though.
Yeah, it would have been a much better.
I think it creates. I think from a trading perspective, I think it broke too many support levels for me. I still got the philosophy of wide range neutrality, and now you're going from 2150 into a breakout at 2300 hypothetically. Nah, that's not me. I don't like overextended breakouts.
Mark, any broader thoughts on the technicals on the S&P 500? Any of the major indexes you wanted to highlight?
No, I mean, those intraday charts, if they keep running strong, listen, I never do as well as more aggressive traders on V-shaped type recoveries where you just go down and then back up. I try to make a little bit of money on the way. I never get too aggressive. But boy, if those intraday charts, moving averages, resistance levels continue to be broke, and heaven help us if we have another surge at the market open tomorrow, right? Those surges the last couple of days, notable today. I mean, you were coming down, you were fading into the market open, and then boom. Boom. So it's all very constructive on the intraday charts now.
Market open's been getting gobbled up like Matt just talked about. Yeah, I appreciate that, guys.
Well, you're also seeing an intraday breakout occurring right now. So
something I'd like to mention. So the last 2 Fridays, I spoke about this in the stock report actually, but the last 2 Fridays, we've had aggressive selling into the close, right? And that's kind of put traders on edge a little bit. So it was very interesting to see Monday of this week, a big spike in the VIX. And then all of a sudden Tuesday turned out to be a green candle. So it was green on Monday on the VIX and then green on Tuesday of the VIX, but it was lower. And so then we got into, the day before that Matt talked about, the day of the Fed speak there. And yeah, that to me was a very clear signal that, we had to go intraday and start looking at this and go, okay, is there a personality change coming? And that's exactly what Matt described. Was there that the cash open getting beat up all the time? All of a sudden there was that shift in that mentality, and that's what we saw for the last couple of days, and including today as well. So I thought it was very interesting that the VIX was actually telling the story along with the intraday analysis.
Gotcha. All right, Matt. Next, I want to talk a little bit about just maybe one or two sectors. I did see XLY firing back towards a resistance breakout. I had a question for you on a technical perspective on that, if you want to, or we can finish up on indexes if you've got other thoughts.
Oh no, I was just looking at my trend line, violating that trend line intraday too. It's starting to build.
And that 4420 level, that broke down is now back above it. So there's some good stuff happening there on that S&P 500 from a charting perspective. Let's see if we can get it lined up.
Well, and here's one last point on the indexes, guys. One of the really big important factors here with the market recovering like this, and the strength of the recovery over the last 2 days, and it getting back above these very key technical levels called the 50-day moving average, is a lot of those charts that we're looking at bearish retracement type analysis. If you start to stabilize above that 50-day moving average, we're talking about bear stop out day in the entire marketplace.
Bear stop out day. Yeah. It's starting to shape up
that's what a maintenance mode above with the market close here today, I think is fairly telling for the market mentality. But again, I kind of go with Greg. Give me a Friday going into the weekend just to kind of confirm that. But it's starting to build.
Yeah. But here's the thing. If Friday going into the weekend continues to confirm on the S&P 500, I think we might get a breakout in a couple of different sectors potentially here on a Friday. And there's two that really grabbed my attention, Matt, XLY and XLE. Those two stood out just for me.
It's getting close.
We're getting close to that breakout on XLY into new highs, and XLE. We'll go to XLE in a minute here, but it also is looking like a breakout candidate for me. What are you seeing here, Matt? Because if that happens tomorrow, I'll take it. I don't want to miss it.
And honestly, the speed of the recovery in XLY has been quite impressive. And honestly, I just said this on the Russell 2000. And so this is not consistent analysis, but I do have a different perspective on the discretionary sector than I do the Russell 2000. I do not like overextended breakouts, and that's what I do see the Russell 2000 as. However, I do not have this same philosophy in the actual discretionary space. When you're looking at the discretionary space right now, you're talking about a one-day gapping situation where the market recovered back up into the exact same range within 2 trading days. I kind of feel like this is just a fake out, shake out type scenario. I'm looking at this breakout the same way I was looking at it last week, quite frankly. I see the gap down here. I understand it. I understand there's context around it. I am discounting it 100%. The reason I'm still looking at this weekly chart and I'm saying, I love that breakout there. I love that breakout on the discretionary space. Discretionary can get hot, and it can get hot fast. And so I'm looking at that discretionary space. And when you're looking at the RSI here, again, RSI, relative strength indicator, it is a very, very popular indicator to help understand what I'm talking about in terms of those overextended breakout scenarios. And so when we're looking at that 185 handle right here, and we're currently at a handle of 184.65, RSI right here at 53, crossing the 50 barrier. Anything with a positive slope, and yes, that has a positive slope now, anything with a positive slope above 50, underneath 70, when you couple that with where you're at relative to the breakout, you're going to say you still have some room to run upon that breakout occurring. And so we have not seen the breakout yet, but if that breakout does occur and we do close above 185, I do think technically you have to call that confirmation. And also because of the time frame in this consolidation, which is now months and months, where you're really kind of looking at an ascending triangle continuation pattern, I think you got to be looking at that 185 breakout in discretionary and saying, you know what? Where can it go next? 190, 200? We don't know. What we do know is when a sector breaks out, that's an opportunity. I don't have an overextended philosophy on the discretionary space right now. I think it has good value with the breakout.
Yeah, and that breakout in discretionary is going to dial up with a bunch of different companies in that space. One of them, Home Depot. Keep an eye on that one. Pushing towards
if we're going to keep an eye, we might as well take a quick peek at it.
Look at this 340 breakout.
Look at that 340 breakout. That feels good.
I think so.
Wickety wick. That feels good above 340. Let's take some of our darlings. They should get Yasla. but I was trying to do Tesla there. Tesla, recent breakout. I'm sorry, it's just no longer the breakout darling. I still like the 760 breakout, though. I still like that 760 breakout there. I think it's actually solidifying itself, even with the gap down that obviously the entire sector did. We're taking a look at Amazon as well, big dog player in the market. We were looking at that as a potential breakout. That's back into mud here in Amazon. But again, even though Amazon's not in a trading scenario right now, you certainly do have a philosophy that it just kissed off the 200-day moving average. You can absolutely see some price appreciation as Amazon comes back up into the resistance levels. That is going to help that breakout in the discretionary space.
And we'll rapid fire through a few more, Matt, because I really dug into this one. Look at MGM. Look, MGM in the space as well.
MGM's technically a breakout against the short term. You're looking at a resistance level right there at a 43.65. You are going to confirm that. The only question I think traders will have is, do you care about that wick? I don't. I think the 44 handles the breakout. MGM looks good right now. And then when you look at it on a weekly chart, swing traders might look at this and say, I don't want to chase 40 to 44. I don't want to chase in front of 45.34. I could certainly understand that. Well, if you look at on that weekly chart, it does look pretty primed to have a nice little run if you do get above 45. So I think position style analysis, obviously MGM's a really good cash flow company as well. I like a position style scenario on MGM right now.
Even Chipotle is breaking out.
We're not going to look at Chipotle.
I know.
I kid.
Hey, man, I've had a Chipotle burrito in a long
just
time.
because I have good taste in burritos doesn't mean I won't analyze a bad burrito company. I kid. I joke a little bit. Let's go. Yeah, it looks like it's breaking out.
It is breaking out, especially on the daily. Energy, though, was the other one I wanted to highlight because really the strength in crude recently and then the bounce back in stocks has kind of given it a double whammy here to where the energy charts are really shaping up here, Matt. This is after a couple of months of consolidation, just one I think people have to have on their radar.
100%. That's a breakout with confirmation here on a no-sell day. Oh, the only thing it's missing, and this is not meant to throw cold water, just as a little bit of an indication. Volume. Where's the volume?
It's not there yet. It's even.
Big buys.
But we
big buys. Big buys. Let's look at the S&P. There's the selling volume. I'm going to have to get in a little tight there to see that day today. Let's get that up. You want to see volume start to pick up. See, and again, the reason, you want to see broad-based market participation on a recovery like this. And so that's the only thing I'm seeing right now is let's get a little bit more volume behind it. But outside of that, it on those two sectors itself, discretionary and energy, I like them both right now.
That's fair. Mark, Greg, anything you want to highlight stock market sector perspective before we move into commodities?
No, I mean, the only thing is, will you humor me for a minute? Because I was looking, when you go back to, in fact, it's right there on the chart. You look at the volume of the pre-election sell-off. The last time we had a dip of magnitude was before the election. And you did see on that, on the election volume, the volume on the way down was actually pretty light relative to the volume on the way up of the election. Now we're having similar candles, drift down below the 9, below thing. People are worried. But then you saw some higher volume than you did over the previous 2 weeks. When you look at the volume for the previous 2 weeks, it was lighter than the volume on the way up of that. It would be nice to have that to give bulls a little more umphidium.
Well, yeah, and that's why I say, hey, I'm not saying this is a criticism or an indication of, hey, let's throw some cold water on this, bullish parade that the intraday analysis is forming up here. Volume certainly can pick up coming into the close. And as the recovery starts to take hold, volume can come in next week as well. Volume's a story over time. It's not a one-day scenario.
That's right. And we still have a couple hours here. We'll see if we get a little bit more to come in before the end of the close. So, yeah. And then, Mark, you mentioned earlier you saw crude oil getting froggy here. It obviously is helping that energy chart. Let's flash through commodities real quick. Matt, it's got a nice little move after it broke out of that 70 retrace. Now we're moving and extending towards that. It's staring me right in the face, though, top of the box. Still got box analysis here. Anything grabbing your attention outside that?
Yeah, I talked about this on Monday. This is what ultimate, breakouts against weekly charts start to look like in wide range neutrality. Energy's been doing it for about 4 months. The Russell 2000 has been doing it for 9 months now. But before ultimate weekly breakout, you start to see the daily charts start to solidify themselves. You start to see daily charts forming higher levels of resistance, higher levels of support. And that's what you are seeing in crude oil right now. And I think the consistency of the price action has given some confidence in the traders to carry these trades a little bit longer than they typically would in wide range neutrality. And so when you're looking at this now from a short-term technical perspective, I'm really this is something technicians will have to learn over time. What amount of data set to look at, right? That's an open question a lot of traders have. As a swing trader, do I look at 3 months, 6 months, 9 months, a year, right? And I've heard so many different educators and so many different traders in my career be like, oh, you got to look at this time frame. You got to look at this time frame. And I have as big of differences with those answers as I do, hey, a swing trade definition is 7 to 10 days. No, it isn't. It's subjective. It's pivot to pivot. It's based on the personality of the stock. And I feel like you have that same type of conversation with yourself as traders when you're looking at how much time frame should I look at. Well, to look at the short-term trend, that might be 6 days, or it might be 6 months, or it might be 16 months. It depends on the consistency of the pivot relationships. And so when you're looking at this short-term trend, you really didn't have a short-term trend until you had that pivot confirm right here. And so at this point, and this is a very telling story to me, this candle inside that candle against that higher level of resistance. At this point, because before that, you're just looking at consolidation against a 50-day moving average in a backdrop of absolute neutrality, if not bears have control. Now you're looking at a scenario, the picture's just changing a little bit because of the consistency in the analysis. And so what you are now seeing this as is not a fight against resistance. You're seeing that now as a higher level of resistance. You're seeing that as a higher level of resistance. And this now being the second higher level of support, which means now you have this confirmed bullish uptrend in the short term going against the backdrop of these resistance levels in the long term. And I like the ability of crude oil to be able to break out of this range, given the consistency of this $70 bounce, given the market overall bullish mentality over the last 2 days, getting back up above the 73 resistance handle. And on a no sell day where it did kiss off a rising 9, you got to like crude's ability to get back up above 75. But once again, I will say this every time until it breaks, it's still resistance until it breaks. And it has been proven to be very strong resistance, both in June of this year, but also historically. And so everything's resistance until it's not. It's got to break, but you got the analysis leading in with a great opportunity to break out of that 75 handle.
Yeah, I agree with that. And what we've been saying for a long time, it can't hit those high side price targets from Wall Street. All those Wall Street firms with those $90, $100 price targets can't do it until it gets above the resistance we're watching here over the last couple of months. All right, appreciate that one. And then gold here, Matt, next, and Bitcoin last. And we're going to go into stock talk. We talked about the bear retracement on the daily. It hit that. It hit its head against those levels, Matt. It sold off back down to where support. Anything else you want to update here on gold?
No. I mean, this is one of the environments where gold is and always will be a difficult trading vehicle because of all the different variables that drives gold on both a daily and a weekly perspective. The reality, though, is the number one driver of gold in the digital markets, in what we're seeing here on the gold futures contract, is market mentality. If the market's up post-Fed, guys, gold will be down, because gold is seen ultimately by most market participants, the ultimate form of analysis, as a protection mechanism. Well, if the Fed just told the market to buy and the market over the last 48 hours has bought, what's the reason for gold? There really isn't one in that environment. That's why you're seeing a little bit of the sell-off. The question is, can it violate 1740? And the ultimate answer is absolutely it can.
Yeah, of course it can. It's got weakening daily technicals and we're pushing towards support, so it can do it. You got to keep an eye on it for short-term analysis, no doubt about it. And by the way, I'm seeing a little bit of the same kind of thing developing in Bitcoin. I want to get your technical read on this, Matt. A little bear retracement developing. I like the fire off 40. I know there's longer-term analysis that's very different, but what about just the very short-term couple of day candles coming back in here? Do you like it, or do you still see some hesitation?
Well, I don't know if hesitation is the right word. I think the technical analysis needs to solidify itself. But when you're looking at it from an intraday perspective, guys, gold and Bitcoin are a little bit different. So no, I don't have the same philosophy towards the bearish retracement on Bitcoin as I did on gold. I mean, yesterday when Tyler was analyzing gold, I was like, yeah, that's a bear retrace. Like that's. And everything underneath 1840 is a stay away for me from gold. Bitcoin, we didn't see that sell off. Bitcoin, we've been talking about it above 44K. It did cross above 44K. I do think 48K makes some sense, but I don't think it's going to be clean. I think it's going to be dirty and choppy. But I do think we're back up into the ranges that we were at before the vicious sell off from last week. And so when you're looking at this on a daily chart, you see that range right there at about 44K right there. You're back up above that. Now you got to fight against a downward moving 9 EMA, a downward moving 20 SMA. It's going to be choppy. It's going to be ugly. But no, I'm back. Technically, I'm back into some degree of neutrality in Bitcoin.
Gotcha. All right. Thank you.
I still have a bear lean on gold.
Thanks for reading that chart, though, the way you just did. Appreciate that. That tells a little bit more of the story. All right, guys, that's all I've got from a market Skyline perspective. We're now going to transition into stock talk. Just got a couple of different stories. But before we do it, Matt, I want to make a quick, simple pitch. If you can head over to tackletrading.com, I am going to promote something I do every single day. And let's get the word out there. Guys, if you love individual stock stories, market stories, and you want to get them after the market bell, like I did a write-up yesterday on the FOMC and what they had said, all that kind of stuff. 5 o'clock Eastern every single day. The huddle is released on tackletrading.com. It's a podcast, but it also has the write-up of all these different stories, earnings reports, detail into what happened, all that kind of stuff. I know that you'll love it. I do it every day. It's a wonderful, wonderful podcast. Support it. You know, if you're Team Tackle, go and find it on Tackle Trading. Subscribe on your favorite podcast apps, Spotify, iTunes, any of the other ones, Stitcher, TuneIn, you name it. You can find it anywhere that you can get normal podcasts. And if you like listening through the website, Matt, we do have the play button right there on the top as well. Just wanted to promote the huddle there, Matt. I love it. I hope people can get some value out of it. Anything you want to say about it?
You know, honestly, I eat, sleep, and breathe market news, as all of you guys do. And quite frankly, I love listening to the huddle every single day because let me put it like this. There's always something you put in there that I didn't catch somewhere else. And I absolutely love your base in your story number one. What I love the most about the huddle, because most of the other stories I'm reading as well. But story number one is just your quick take on what occurred in the marketplace. Literally in less than 3 minutes a day, I understand what at least from a performance perspective, what the relevant areas of the market I need to be familiar with at a bare minimum. You cover in less than 3 minutes. I absolutely love it. You do a great job.
I appreciate that, bro. Yeah, and I know that a lot of people could get value out of it. So I've dropped the link. Just want to keep getting visibility on what we're doing out there to help people. Yep. All right, back on the market here. A couple of stock stories, Matt. Not too many. I only have one actually from my dear friend Salesforce.com. I know we had a couple of earnings reports as well. Where do you want to start?
We can start with Salesforce doing good Salesforce things.
Dude, this is what Salesforce does.
Don't bury it. This is your moment. Come on, you've taken some heat. Come on, dance a little bit. It's okay.
It's not.
I'll get the glitter and I'll pour it on your head. You've taken a lot of heat from some of the coaches, i.e. Mark, over the course of
I have never said a negative word to
neutrality.
my brother Tim in his entire life. I have no idea what you're talking about.
If you're new to tackle trading, I'm a long-term
I'll defend
investor.
your honor.
I'm a long-term investor in Salesforce.com, believe in the business model, believe in the management, love what they're doing from a revenue model perspective.
They even justified slacker performers for years and years and years.
Like I did, as a matter of fact.
Yeah.
I listen. It's all coming together.
It's all gravy on a breakout, bro.
Hey Tim, you're not alone. I read an article yesterday that CRM is in the top 30 stocks for over 71% of the hedge funds. So you're not alone. You're not alone in the CRM.
I think it's going to be 74 by the end of today. So
it was 71. It was 71 when I read it yesterday. So
firm believer it's a long-term winner, and they raised their 2022 guidance, jacked it up. They see sales increasing up to 26 billion, or actually, I believe 31 billion, up from 26 billion. Matt, they jacked guidance by $5 billion. This is a company that's showing a really good earnings response just this last quarter. I love what they're doing. And obviously the technicals are the technicals here, and they're breaking into or approaching new highs. What's your reaction to Salesforce? Any thoughts here on the technicals?
I think with the Fed punting yesterday, you're going to see a lot of jacked up guidance for 2022.
That's fair. That's fair. Don't pour water on my
money's got to go somewhere, bro. Like, inflation's got to go somewhere.
Yeah. So Mark's never said a negative word, and Matt's always had passive aggressive responses to Tim. This is awesome.
Tell me I'm wrong.
You're not wrong.
I mean, that's how kind of inflation works. But,
it's true.
But no, I all kidding aside, I mean, legitimate upgrade here, guys. I mean, we've seen illegitimate guidance nonsense. We see it all the time as market participants. This is a legitimate, great upgrade in guidance for Salesforce. And I'm with you, Tim. Mark Benioff has built a giant. He's built a juggernaut. He's done it the right way.
Yeah, their revenue, their consistent subscription revenue is a really impressive thing if you really dig into their numbers. All right, that's it.
If you want to see a pretty picture of growth analysis, go look at Salesforce since the inception.
Mm-hmm. And the way they make their money, it's just impressive. Yeah. I'm a long-term believer. Everybody knows that. All right, any earnings that grabbed your attention there, Maddie? I know there was just a couple that had them today. They weren't really big major names.
No, not a lot of big names. I'll rapid fire a little bit of earnings very quickly, though. Let's start in the housing sector with the good old-fashioned KB Homes here. KB Homes comes out, reports 164 against 160. Revenue came in slightly under the expectation of 1.6 billion with a 1.5 handle. That did result in a 46.9%. Market response was muted as it should have been. We had a slight beat on EPS, slight miss on revenue. Revenue did explode about 47% though, so you can kind of offset. And the miss on revenue was literally pennies to a revenue machine like KB Homes. So not a lot of concern here, but not a lot of price action. The question is, does that have any impact on companies we actually really like in Lennar, or when you're looking at DHI in terms of DH Horn? I still think those are the two you're looking at for any type of recovery cash flow scenario. But if you're a little bit concerned with KB Homes earnings report, it passed. The market took it like a punch. I'm going to go from blast from the past. See if you guys can guess. Blast from the past, very popular trading name in the 2000s that nobody cares about today.
GoPro.
Tech company.
Oh, you are such a troll.
That was the 2010s, by the no, Greg. You're not thinking old money now.
We're going with BlackBerry here, and the reason I bring it up is firing off the lows here. I want to get old money Home's take and old Mark's take here. Firing off the lows, BlackBerry lost money as BlackBerry typically does, but they did lose 6 cents against the expectation of 7 cents. So it's slight beat on EPS numbers. Revenue came in slightly above the expectation. By the way, this is so funny, but they used to have a government contract that paid them billions and billions and billions and billions and billions and billions and billions of dollars. They cashed in 175 million last quarter for against the expectation of 163. That resulted in 32.4% revenue increase. So we officially do have a beat on EPS numbers. We officially have a beat on revenue numbers. And revenue did increase an impressive 32.4% for BlackBerry. The reason I brought it up, I always just kind of geek out around that $10 significant whole number. Anytime you got a stock around there, I just kind of take a quick peek. It's one of those very important, significant numbers. Any interest in a company like this firing off the lows, Mark, or is this just BlackBerry and we should just move on?
I want to hear Mark's thoughts because this was that Reddit.
I got a few of my own.
Yeah.
After Mark's done.
done many naked puts on BlackBerry, playing different things along the time. It's treated me well. Like long term, I have a hard time with a company. They might have beat expectations, but those were reduced where revenue is going down, right?
Yeah.
It's not, I mean, there's so many growth companies I love, you know, the SoFis, I mean, there's a million, you know, revenues going up, blah, blah.
Wait a sec. Did somebody say SoFi?
I think somebody said SoFi. Yeah.
Did somebody say SoFi?
SoFi.
Like,
SoFi kissing the 200-day moving average today. Hammer candle.
That breakout is cleaning up.
Yeah, I kind of like it.
I like it.
It's cleaning up. Like, just give me some stability here. Yeah, no, I might have looked at the chart.
So the answer was no for you.
But, I mean, it's the thing is like, do I mess around with it every once in a while
No.
when I see a good volatility opportunity? But I mean, when you have revenues decline, it's hard to get excited.
Sure.
Okay. Greg,
So-
your thoughts.
Right on. And so this is going to be truly Canadian analysis for you. The problems with BlackBerry started a number of years ago when Jim Basile decided he wanted to put a hockey franchise within a 15-minute drive of the Toronto Maple Leafs. So this is what I like to call Toronto Maple Leaf syndrome. As soon as he tried that stuff, he got a little big for his britches, and all those billions of dollars from those government contracts disappeared. And this is the result of it. Now it's a $10 stock or whatever it is.
I heard Canadian talk.
Yeah, it's very Canadian, but it's a lesson. It's a lesson in remembering who you are. And unfortunately, Jim Basile forgot who he was, and he was reminded by getting beat down in a big way. So
Got it. I like
You guys still play
well, something that
hockey?
has, yes, people play hockey, but something that not a lot of people have interest in is something a lot of traders and investors have interest in. Darden Restaurants here. Darden firing off here today, kissing against the breakout before the earnings report, post earnings report. We got a doji after a firing action, and understandably so. I mean, Darden came in 176 versus 163. Revenue came in slightly above the expectation, 2.3 versus 2.2 expectation. That resulted in a 51% increase in revenue year over year. And they weren't done there. Again, slight increase in guidance for the year of 2022. So another company with a slight increase in guidance for 22 joining Salesforce here today. You saw Salesforce pump it up again. Darden doing a little bit similar. What's your guys' technical read here? Let me start with Greg on the weekly chart. Old money, what's your read here?
Go to the weekly, yeah.
Yeah, nice breakout on the weekly chart there. With the daily look, I love the response after earnings. It's it's obviously being rewarded for that. As for a technical trade or technical read on it, I don't think you can trade that big doji that we got on the daily. I'd like to see it settle in a little bit before I got involved, but you can't argue with the bullish nature of it.
Yeah, I think this is one of the scenarios where you like the price response, you like the backdrop on a multiple time frame, but I think every coach that is technically trained would be like, you got to wait for that secondary pattern.
Wait for the next setup, yeah. And then
whether that's a high base or a flag, we don't know. Gap fill, we don't know, but let it develop.
My question to you is, which Darden restaurant better, Olive Garden or Texas Longhorn Steakhouse?
There's
not an answer to that question.
They are even.
Now wait a second. Is it Texas Longhorn? Or is it Texas Roadhouse?
It is the Longhorn Steakhouse.
It's Longhorn.
Oh, okay, all right. No, because when my wife and I used to go to Port Huron, we would go to Olive Garden or we go to Texas Roadhouse, and they were literally one beside each other. And as time went on, Texas Roadhouse always won out. You get a pretty good meal there and some cold beers.
Steak or pasta?
Yeah, steak.
Essentially, that's what I'm asking. Steak or pasta?
It's not the best brand they have, by the way. Yard House is amazing.
Similar. Right. Yard House is awesome.
Is amazing. Cheddar's is amazing. Seasons 52.
Yeah, but they don't do the revenue that.
Yeah, those are
all
amazing.
Never heard of any of those.
Yeah, I was gonna say, like, that's some bougie stuff out of my brother. And
Yard House is, well, I traveled a lot.
That's travel. That's travel.
That's travel talk.
Travel.
Yard House is like a brew pub. It's got a great vibe to it.
Yard House is
great. Like made from scratch stuff. Season 52 is high end fish and steaks and stuff. Out of the two you offered, Mark, I'll take Olive Garden for the nostalgia. Give me the the salad
pasta?
And the soup and the breadsticks and the pasta. You bet. Yeah, you bet.
I'm gonna go with steak. Yeah.
Why not?
Well, they all must be doing reasonable because Darden's numbers not too shabby.
Revenues are up.
Slight increase 2022 as well. Once again, keep a look at this secondary pattern that develops on Darden. Then the last one I want to quickly go through, just big dog out of Ireland. Let's go with the Accenture. Accenture comes in at 220 versus 219. Revenue came in line 13 point versus 13.4. Revenue resulted in a 23.5% increase year over year. Nothing to see here from a fundamental perspective. I did just, again, I was looking at kind of earnings responses just yesterday and today from a technical perspective. This one caught my attention a little bit, kissing against a 345 resistance level. Looking at that weekly chart, looks like a high base scenario on the weekly chart. Unlike Darden, which needs a little bit of technical development post earnings and letting that volatility subside, this one looks like a tight breakout channel with a nice little positive response to earnings. Technically, what's your read? Let's go to Mark.
It looks pretty clean, right?
That's why I went to you. He's going to hate this. He's going to hate this, but he can't say anything against a high base breakout on that weekly.
It's pretty clean. It's taken a month off for the 9 on the weekly chart to catch up. I mean, I don't go directional often, but when I do, this is the type of setup that isn't.
But when I do, I buy a ACN. On a high base breakout.
It's just
because I can't say anything negative. I knew he would love the weekly. I knew it, so I got him. I feel good. I feel like my day is accomplished. I got Mark on a weekly breakout against an all-time high.
Yeah,
we got to get Christian to do a
and by the way, Mark,
meme for Mark.
That is how I will beat you at Trade Masters.
Yeah. Oh, that's assuming I beat Greg. So Greg, he's already throwing you under the bus.
Oh yeah, I know what he's doing. Hey, we got to get Christian to do a meme for Mark though. I don't always go directional, but when I do, the most interesting man in trading, Mark Justice. Everybody.
I like that a little bit. There's something there. I don't know exactly where it is, but there's something there. All right, guys, is that it, Matty?
That's all.
Earnings roundup. Last thing we're going to do here today, actually, we're going to try a new segment out today. Greg Old Money Holmes joins us each and every Thursday, and he is a fundamental analysis master. I mean, this is something that he's really focused on for his entire career as a trader. He brought his, old money ways, his old money thinking, his old money analysis, and his training into his trading as he started in the markets and really focused on fundamentals. And that's what we're going to do today. This segment is called A Focus on Fundamentals. And what Greg is going to do is put the fun in fundamentals. Greg, I believe you're going to highlight something around PE ratios today. What do you got for us?
Yeah, so fundamentals, it's not, it's about a perspective thing. First off, I'll qualify it with that. We're not looking at a day trade or a swing trade when we talk about fundamentals. We're looking position and we're looking investing. Now, because I was a financial advisor many years ago, the whole mutual fund business was based on fundamentals. That's how they built out these portfolios, things like that. So I took that training and kind of, built my own, stream of portfolio building techniques, if you will. And fundamentals plays a large part in that. So I basically, in my head, in my methods, broke it down into kind of two different categories, if you will. There's financial or fundamental stability of a company, and then there's fundamental valuation of a company. So it's kind of like, do I like it long term? Do I think it's a good company? That's kind of one side of fundamental analysis. And then the other part is, am I getting a reasonable price? Am I getting a fair deal? Am I getting value from it? You listen to the greatest fundamental or value investors. This is the fundamentals are what they look at. And so for me, I kind of split it into those two things. And so the rabbit hole we're going to go down first in this segment and a few others is we're going to start with the valuation part of it. And then we'll talk more about how we find the companies that we really, really like. So if we think about price earnings ratios, again, we're trying to ask ourselves when we look at these things, are we getting a fair deal for buying into this company? When we buy into a company, we are paying a certain amount to get a portion of what they make, which is our priced earnings. So the price is what you pay, right? The earnings are what you get. You get a portion of that earnings, right? So it's a value metric. It's like, okay, am I getting a good deal, right? You go buy a car, you pay $50,000 or $100,000. How do we know that we're getting a good deal, right? So you need to have something to work off of. So priced earnings to me has always been what I pay to what I get. So the price of a stock could be $100. If they've got $1 in earnings, that means I'm paying $100 for $1 of earnings. That's 100 PE ratio there. Well, what does that mean exactly? Well, unless you're comparing that PE to another company in a similar sector, in a similar industry with similar traits, it really doesn't mean that much. But when you start to compare those two, then you can kind of get a value perspective of it. And so, you know, the ones that I thought about today were Coke and Pepsi. Okay, so nobody can argue that Coke and Pepsi are not in the same business. They're absolutely in the same business. However, they're very different prices, right? So the Coca-Cola is a $54 stock. Pepsi's 100 and something. What do we got for Pepsi? 154. So you got two different stocks. Now the question is, they're in the same business. You know, how do I evaluate? Okay, what's a better one to be a part of, right? And so that's where price to earnings ratio can come in. We can look at a PE ratio and we can say, okay, we need to pay a certain amount to get $1 of earnings. In the case of Pepsi here, and all these numbers, by the way, are coming from FinViz. So in the case of Pepsi company here, we're looking at a PE ratio of 26.06. So essentially what that means is we're paying $26 in price for $1 of earnings. Okay, so like I said, of in itself, that really doesn't really tell us that much. But when we can go look at another stock that's in the same business, right, and we can say, okay, well, Coke does the same thing as Pepsi, but Coke's 1/3 the price of Pepsi. So which is better to buy? Well, like I said, Coca-Cola has a PE ratio of 29, whereas Pepsi has a PE ratio of 26. So even though we're paying more money for those earnings, we're actually paying less. We're getting better value from Pepsi from a pure price to earnings standpoint. So we're paying $29 for $1 of earnings in Coca-Cola, and we're paying $26 for $1 of earnings in Pepsi. So when you just look at it across the board and you compare the two, just that one metric would say that Pepsi is a better value, not necessarily a lower price, but a better value than Coca-Cola. Now, that's not the only metric that you would ever use to compare these two, but it is one of the many fundamental metrics that we can use. And it's one that I use quite often when I start to look at, okay, do I like a couple of similar companies? Now let's go down and start drilling down into different metrics to see, hey, do I like this one better? Is there other things that I can look at? Price earnings ratio is one of those things.
Okay. Maddie, what do you think of the PE conversation here and Greg's, with Pepsi and Coca-Cola here? Any thoughts on this?
P ratio is a fantastic, very simple way to understand the valuation question, and that's the question that every investor should at least go through the thought process of making when they're making a decision to invest in a company. Mm-hmm. Too many times we make decisions based on dollar figures, right? We see, like I hear it all the time. Oh man, XYZ. It doesn't matter what the company is. Give me any company.
Chipotle. We talked about it. Yeah.
Thank you, troll. Chipotle, right? You can see it right now. Everybody looking at Chipotle saying, "Oh man, I wish I would have bought it at 1,200." Right? Mm-hmm. Well, what does 1,200 represent? Other than just the price you're paying, mm-hmm. Right? It's not, the price literally has very little to do with it, because price is just what you pay. Your position size is based on price divided by, how much you're willing to put in from a position size perspective. And so the price is just what you pay. Warren Buffett said this better than I could. Value is what you receive. And so when you look at the price, too many times I think we as traders simply look at the price of an instrument and we assess the value simply from our understanding of price relative to history, when what we should do it is price relative to performance. And that's from a value perspective. And so when you're looking at the P ratio, a P ratio is a very simple way of understanding the valuation question that investors absolutely have to go through in making a decision to park money into a long-term investment. Because what the P ratio states, and you can do this on any company, but let's go to, you asked me the question of Chipotle, right? Mm-hmm. Let me take that down. Okay, so you asked me the question of Chipotle here. So let's go to Chipotle and let's look at what 1948 represents. Well, if you're looking at 1948, what that represents, ladies and gentlemen, let's understand this more than anything here. You can see that valuation right there. So I'm erasing things. You see that valuation right there. Okay, so what that represents is based on current CMG's earnings report, based on their earnings per share, it will take 92 years for you to pay off the investment. Now, I'm 43, going on 44, and I do plan on living to 275. Sell research, guys. But that might not occur. I don't know if I'm willing to put my money in CMG and wait 92 years to actually make a profit off the investment. Now, again, there's many metrics of how you can make money as a trader. This is simply just telling you one. It doesn't tell you growth potential. It doesn't tell you cash flow potential. It simply tells you that if you're paying $1,948 based on its recent earnings EPS number, it will take 92 years for that to pay off. Well, what Warren Buffett said, as taught by Benjamin Graham, the wonderful, wonderful, wonderful author of The Intelligent Investor in the early 1950s, what Benjamin Graham said is and this is how fundamentals or technical analysis works. It starts working based on somebody's assumption, and then other people start using it. Well, what Benjamin Graham studied in the 1930s, 40s, and 50s and taught Warren Buffett was that a PE ratio of right around 20 is kind of where you want to be in your zone, right? That gives you some degree of fair market value, right? Because if you can park your money into an investment, pay off that money based on EPS numbers in a 20-year time frame, that's about 2 market cycles, guys. You take onto that, you put the cherry on top of that nice little dessert called a dividend. You're compounding. CMG it's not going to pay you one, but again, we're just using, you gave me CMG example to use it as an example. Well, we're also going to capture the dividend. And you know what we're also going to do? We're going to write covered calls against it because Warren Buffett's a cash flow compounding king, right? And so we're going to do that. So all the PE ratio states is the amount of years it's going to take for you to pay off the investment based on the EPS number. And so that's what it basically states. Now, another version of the P ratio, if you want to understand that, to understand market valuation, is if you go to what is known as a Shiller PE ratio. And what a Shiller PE ratio is it's after the famed price economist Robert Shiller. And what Robert Shiller basically argued is that when all you do is take price divided by earnings per share, it does not give you an accurate measure of true fundamental value, given the fact that the price can fluctuate quite aggressively against the earnings per share. So for example, price fluctuates every second of every day, and it can do some very, very crazy things in the short term. Well, fundamentals track over time. And so what Robert Shiller basically says, he took the CAPE ratio, and he basically did what is called a cyclically adjusted PE ratio, and that became known as the Shiller PE ratio. And the Shiller PE ratio can give you the same type of understanding from a valuation concern or a valuation opportunity in the broad market, the same way Greg was talking about it from a individual company perspective. And so as you can see, and again, the stock PE ratios metric is kind of 15 to 20, right? 15 to 20. Well, the reason that is the case is, number one, that's what Benjamin Graham said to Warren Buffett, and that's what Warren Buffett said to us, right? Us as collective market participants. It became known as a standard. Well, what Robert Shiller said was, we're going to track this historically over the last 100 years in the marketplace. And what we have found is the average, medium, or mean is about 15 or 16. And so that's what we would consider fair market value from a longer term perspective in the broad market. And so you can do the same thing. And again, the only point I'm trying to make here is you can do the same thing from a market perspective as you do from an individual stock perspective. And what I've kind of adopted for myself is I adopt the Shiller P ratio as this standard against how I judge all other valuation metrics. And so, and by the way, it's not necessarily against the S&P 500 itself. It's more against the S&P sectors. And so what I'll do is I'll look at Coke compared to Pepsi, compared to the actual sector itself to really assess fundamental valuation. Because when you're looking at Coke and Pepsi, one with the 26, one with the 29, the difference is 3 pennies on the price tomorrow. And so I don't really see, and I'm kidding with the 3 pennies, but you get the point. The point is there's not a lot of fundamental valuation difference in those two metrics. But if I would have compared that against the actual consumer discretionary consumer goods sectors, you might have a different take on the net understanding of valuation of Coke and Pepsi against the sector itself. And so and again, this kind of is getting into everything I do from a top-down analysis perspective.
Sure.
But I just wanted to show an example of the Shiller P ratio as Greg was talking about the stock valuations as well.
I love it, guys. I mean, I've really enjoyed this, and obviously a focus
That
on
was
fundamentals.
awesome.
Something a little bit different than we don't do every day, obviously, because fundamentals are more long-term. We focus on short-term trading mechanics and action on a day-by-day basis, but very important content for people to understand out there. Greg, thank you for bringing the PE ratio conversation to us. And Matt, thank you for answering a couple of questions there on the back end as well. All right, guys, let's start moving on.
And last, CMG still does not have proper valuation.
What's the PE ratio on one of my favorite stocks, Lucid, who hasn't made a sell yet?
It's called negative.
Negative 8 billion.
They don't tell you. It's just going to say 0.
It's funny. You say
they don't want to know how bad.
CMG had a PE ratio of 92.
92.
I remember not too long ago. Didn't it have like a 1400 PE or something? Wasn't it insane like 3-4 years ago? Like it was an insane PE ratio.
In the last 7 years of CMG's PE ratio, it's went from negative to like 14,000 back to negative. I don't understand how anybody has a fundamental view of CMG. It's a growth stock and it's just got to grow.
Yeah, it's got to grow. All right, guys.
It's tough to apply longer term valuation fundamental analysis on growth stocks. Like they're different metrics.
Yeah.
Dude, I'm going to have a burrito and a Coke for lunch.
Yeah, but you're not going to have a Chipotle burrito.
No, I'm not. I've got one in the fridge. I'm going to go heat up. So absolutely. I'm going to make myself.
I wish I liked Chipotle burritos so I could talk trash with Matt, but I don't either. So
yeah, it's not your thing. Let's get final thoughts. Let's start wrapping up.
Not that good.
Dude, some people love them the whole way.
I get it. But some people love it because they dump a whole bunch of stuff on it.
That's right.
It's a good vegan. They do make a good vegan. They got some really good vegan stuff that I like.
Didn't the Queen say she liked Chipotle as well?
Queen M does.
I think she did. Yeah.
I know if I remember correctly.
She owns shares. Yeah, she likes it.
There you go.
Marky, programming notes. Let us know what's going on at Tackle Trading today.
Listen, it's Theta Thursday. Listen, we got my Vikings, my trading lab. We meet at 7 p.m. today. It's fun market conditions. It's been a fun cash flow environment. Things haven't been too shabby. Some directional opportunities popping up though, right? And then we got Cash Flow Club. Tyler Craig will be there at 8:30 Eastern, and then Tyler's doing a double dose of work tonight with Bear Market Survival Guide after that at 9:30 Eastern. You can find all of those events on the events tab on tackletrading.com.
Fantastic. Any final thoughts on the markets, Matty? Anything you want to tell the team out there?
No, track that intraday data. I'm looking at the 30-minute chart. I'm looking at a couple points over the next 24 hours. Obviously, we'll discuss them tomorrow. It starts for me with the close here today.
Mm-hmm.
You've had a lot of buildup coming into the end over the last 24 hours. Can that stabilize? I think is an open question right now. You got to like what you're seeing in the broad market as it's starting to build on that daily chart. And quite frankly, the more it builds on that daily chart, the weekly hammer that is forming is very attractive coming off that 20-day moving average as well. And the second thing I'll say is this, as the market does build on the intraday analysis, guys, this is about recovery analysis at this point. Let's not ever get into the point where we feel like we're missing out on opportunity simply because the market's V-shaped recovery. Remember this one truth. If the first movement is true, the second movement will be consistent. It's okay to miss in the short term, but let's stay true to the technical systems in the long term.
No, I love that, Matt. I say it all the time. I hear you say it all the time. If this, and we say it in different versions, but we're saying, if this is real, you ain't missing out on anything.
Yeah.
If it's real, you're not missing out on anything.
The battle's happening, guys.
Yeah.
I mean, and yeah, the Bulls are winning the battle right now, but we need to see them. We need to see them stomp a little bit here. Right after the recent bout in volatility and after the recent violations of support and after an increasing volume condition where literally 24 hours everybody in the market was talking about a wall of worry, and simply because we've put a couple different band-aids on the short term does not change the long-term wall of worry. It just it creates a little bit of a mirage in the short term. Let's see that really take hold coming into tomorrow.
Solidify it, market. You got to show it. Absolutely. All right. Guys, Greg, great job, by the way, getting some real good feedback on the discussion in the chat here. Sandeep, Majid, Smooth, Travis, a lot of our veterans saying they love that fundamental discussion. So
I thought it was awesome.
Guys on that. We are done.
We're going to do it every Thursday, guys. Focus on fundamentals. Every
Thursday, we'll have a different topic that we'll cover. Absolutely. All right, guys, we're done for today. If you've not done it yet, click that subscribe button, click the bell. We're barreling towards that 20K mark, a mark that I've got as a goal here for us to tackle trading.
Can we just get it done so he can stop hyping it? Let's go, guys. Come on.
Yeah, exactly. Get my checklist. It's like
we're stuck in a high base at 19.5 by 20K. Come on.
I need to hit T2, man. It's T2 up there.
Where's the 9 weekly?
Oh, come on.
18.75. Let's go.
Let's roll.
And if you've not done 18.5, let's roll.
That's exactly right. If you haven't done it yet and you want to join a community of traders, there is a link to our pro trial in every one of our YouTube videos. Just go find it below or head over to tackletrading.com. Get 15 days for free to come and see what we're doing in those webinars on the back end and courses and reports.
Yeah.
Until then, everybody, we'll see you tomorrow. Same time, same station.
Same tackle.